The Federal Reserve is the central bank of the United States. Think of it as the nation's financial doctor, always monitoring the country's economic health and stepping in when things get out of balance. It's a powerful institution, but its decisions can feel distant or confusing if you're not following the headlines every day. Its main job? Keep the economy healthy by balancing stable prices and strong employment. The Fed is constantly analyzing data, meeting with experts, and making tough calls to try to keep the economy running smoothly for everyone, from big businesses to everyday families. The Fed's most powerful tool is changing interest rates, which affects everything from your mortgage to your credit card. When the Fed raises or lowers rates, it's like adjusting the temperature in a room, trying to keep things comfortable, not too hot or too cold. When the Fed acts, it sends ripples through the economy, impacting what you pay to borrow and what you earn on savings. These changes can influence your monthly budget, your ability to save for the future, and even the prices you see at the store. Yesterday, October 29, 2025, the Fed made headlines by cutting its main interest rate for the second time in a row, now at its lowest in 3 years. This decision wasn't made lightly. It's a response to growing concerns about the economy's direction and the challenges many Americans are facing. This move comes as the Fed tries to steer the economy through a tricky period, with signs of a slowing job market. Fewer job openings and more people searching for work can signal trouble ahead, so the Fed is acting to try to keep the economy from stalling. Lower rates can make it cheaper to buy a home or car, but also mean your savings earn less. For families looking to make big purchases, this can be a welcome relief, but for retirees or anyone relying on interest income, it can be a challenge to grow their nest egg. The Fed's challenge is to encourage spending and investment without letting prices rise too fast. If rates are too low for too long, inflation can creep up, making everyday goods and services more expensive and eroding your purchasing power. Not everyone agrees with this approach. Inside the Fed, opinions are split. Some believe more aggressive action is needed, while others worry about the risks of moving too fast or too slow. Understanding these decisions helps you make sense of your own finances. Whether you're planning a big purchase, saving for college, or just trying to make ends meet, knowing how Fed policy works can help you make smarter choices. This video will break down why the Fed made this cut, what it means for your money, and why there's so much uncertainty about what comes next. We'll look at the factors driving the Fed's decisions and how they might affect your wallet in the months ahead. We'll explore the disagreements, the missing data, and the economic signals the Fed is watching. From inflation trends to job reports, every piece of information matters when it comes to setting policy. The Fed's choices shape the financial lives of millions. Even if you don't follow the news, these decisions can affect your paycheck, your savings, and your future plans. So, let's dive in and unpack what all this means for you, your family, and your financial future. Because understanding the Fed isn't just for economists, it's for everyone who wants to make informed decisions about their money. The Federal Reserve has cut interest rates once again, a move that's making headlines and sparking debate across the financial world. The main reason? Policymakers are increasingly worried that the U.S. economy is losing momentum. Recent data shows job growth is slowing down, and fewer new positions are being created each month. Major companies like Amazon and Intel have announced significant layoffs, sending a chill through the job market and raising concerns about the health of corporate America. By lowering borrowing costs, the Fed hopes to encourage businesses to keep hiring, invest in growth, and avoid a broader economic downturn or even a recession. This marks a clear shift from last year, when the Fed was focused on fighting high inflation by raising rates. Now, the priority has changed as new risks emerge. Today, the risk of a slowdown and rising unemployment is front and center for policymakers, as more Americans worry about job security. Fed Chair Jerome Powell described the rate cut as an adjustment designed to help sustain the current economic expansion, which is already one of the longest in U.S. history. While the economy isn't in a full-blown crisis, warning signs are flashing, like more people falling behind on car payments and struggling to keep up with bills. The Fed is betting that the danger of a slowdown and potential job losses now outweighs the risk of inflation returning. On top of that, global challenges, like trade disputes and slowing growth overseas, are adding to the uncertainty, making the U.S. economy more vulnerable than before. The rate cut also acts as a form of insurance, protecting the U.S. economy from shocks that could come from abroad, such as financial instability or sudden changes in global demand. Ultimately, the Fed's goal is to keep the U.S. economy resilient and adaptable in a world that feels increasingly unpredictable and shaky. That's why the Fed decided to act now, taking steps to support growth and stability before bigger problems arise. The Federal Reserve, often called the Fed, sets the federal funds rate, the foundation for nearly every other interest rate in the economy. This single rate acts as a benchmark, influencing how much it costs to borrow money, from massive corporations down to everyday consumers. When the Fed lowers this rate, banks can borrow money more cheaply and pass those savings to you. This means banks are more willing to lend, and the cost of borrowing for things like homes, cars, and businesses goes down. That translates to lower mortgage rates, cheaper car loans, and sometimes even lower credit card interest. It can also make it easier for people to qualify for loans, since monthly payments become more affordable. For example, mortgage rates just dropped to their lowest in over a year, making homeownership more affordable for many families. Lower rates can mean the difference between renting and finally buying a home. But there's a trade-off. When rates fall, savers earn less on their accounts. Interest on savings accounts, CDs, and other deposits drops, so your money grows more slowly in the bank. Retirees and others who rely on interest income feel the pinch. For those living on fixed incomes, lower rates can make it harder to cover everyday expenses or plan for the future. The Fed knows its decisions help some and hurt others. Every move is carefully debated, weighing the needs of borrowers against the challenges faced by savers. The goal is to nudge people and businesses to spend and invest, boosting economic activity and jobs. When borrowing is cheaper, companies may hire more workers, and consumers might spend more at stores and restaurants. Lower rates might encourage a family to buy a bigger house or a business to expand. Entrepreneurs may take risks, opening new shops or launching new products, all because money is easier to access. These choices, multiplied across the country, drive the economy forward. Every loan, every purchase, and every investment adds up, fueling growth and opportunity nationwide. The Fed's main tool is a gentle push, hoping to keep growth on track. By adjusting rates, it tries to steer the economy between the dangers of recession and runaway inflation. But every rate cut is a balancing act. Too much stimulus can overheat the economy, while too little can slow things down. The effects ripple through every corner of the economy, shaping the financial decisions of millions and influencing the nation's future. The decision to cut rates wasn't unanimous. 10 voted yes, 2 voted no. This split shows just how uncertain the economic outlook is, even among the experts. Some Fed officials wanted a bigger cut, worried about a weakening job market. They argue it's better to act boldly now than risk a recession later. Others think rates shouldn't be cut at all, pointing to inflation still above the Fed's target. They worry that more cuts could reignite rising prices. This division makes Fed Chair Powell's job even tougher. He has to build consensus among strong opinions. The internal debate means the Fed's next moves are hard to predict. If the experts can't agree, businesses and investors are left guessing. The split highlights just how tricky the Fed's job is right now. The Fed is flying blind. Key economic data is missing due to a government shutdown. Without fresh reports on jobs, retail sales, and factory output, the Fed is making decisions with an incomplete picture. The only major data they have is inflation, which doesn't tell the whole story. The Fed's dual mandate is stable prices and maximum employment, but right now, they're in the dark about jobs. This uncertainty makes officials more cautious and divided. Some want to wait for more data. Others say the risks of a slowdown mean action is needed now. The lack of information explains the deep disagreements inside the Fed. It's a tough time to make big decisions when you can't see the whole road ahead. The Fed's job is to balance two things: jobs and prices. Right now, both are sending mixed signals. Job growth has slowed, and layoffs are rising, raising fears about unemployment. At the same time, inflation is still above the Fed's 2% target. Higher energy costs and tariffs are keeping prices up. If the Fed cuts rates too much to help jobs, it risks making inflation worse. But if it holds back, unemployment could rise. The Fed is stuck between a weakening job market and stubborn inflation. If only one was a problem, the answer would be clear. But with both flashing warning signs, there's no easy solution. That's why officials are so divided. Every move risks tipping the balance the wrong way. The Fed's dilemma is at the heart of today's economic uncertainty. Navigating this tightrope is harder than ever. When the Fed speaks, Wall Street reacts instantly. After the rate cut, stocks jumped, then tumbled as Chair Powell signaled no promises for more cuts. The Dow swung from positive to negative, while the Nasdaq hit a record high. Investors are betting tech giants can weather any storm, but uncertainty rules the day. Bond yields rose and the dollar strengthened as traders dialed back expectations for another cut. The market's wild ride shows just how sensitive investors are to every Fed word. Powell's caution left everyone guessing about December. The split reaction highlights the confusion and anxiety in financial markets. Every Fed move and every hint shapes what happens next. The stakes are high, and the world is watching. The Fed has another tool besides rates: its massive balance sheet. During the pandemic, it bought trillions in bonds to keep money flowing. Recently, it's been shrinking that balance sheet, pulling money out to fight inflation. Now, the Fed says it will stop this process in December, shifting focus to supporting the economy. Ending quantitative tightening is like taking a foot off the brake while cutting rates presses the gas. The Fed will also start buying new, shorter-term bonds to keep banks running smoothly. Chair Powell says the balance sheet won't return to pre-pandemic size. The financial system has changed. Some experts think the Fed may need to buy assets again soon, just to keep the system stable. For now, ending tightening signals the Fed is more worried about a slowdown than runaway inflation. It's another sign of a major policy shift. As 2025 ends, the Fed's path is full of uncertainty. The big question: will they cut rates again in December or pause? The answer depends on delayed data about jobs and inflation. If the job market looks weak, pressure for another cut will rise. If inflation stays high, the Fed may hold steady. Internal disagreements among Fed officials will shape the outcome. Chair Powell's leadership is crucial in this divided moment. The Fed's choices will affect everything from loan costs to job security. A soft landing, slowing inflation without causing a recession, is the goal, but it won't be easy. The next few months will be critical for the American economy.